the last gauge here, and you've touched on it just a little bit in several different other points, but interest rates remains at neutral as it was before. And you talked about the Fed and how it's interacting with interest rates. Is there anything else you'd like to expand on that?
Yeah, maybe a little bit. I think sometimes humans, we often focus on, things that are very recent, and sometimes we're guilty of forgetting some of the history. And, even if we just go back a little ways, not all the way back to the 50s or 60s, but even just 2 or 3 years ago, the Fed in 2017 and 18 was in the process of tightening and raising rates. 10-year treasury rates, which are kind of looked at as a bellwether for the bond market, were around 3%. Today, treasuries are similarly around 3%. Now, what we're missing between 2018 and 19 and today is the incredible ride that interest rates and Fed interest rate policy has taken, right? We saw rates and 10-year treasuries, drop down to just over 0.5%. A 2.5% move in treasury rates in that very compressed time period. That's a big move. A big move also is when we come back to the other direction. We've gone from 0.5% of 10-year treasuries to, a spike almost over 3.5%. I think it's important to remember, though, when you look in a 3-year period, we have come full cycle. The Fed is raising rates. The market is anticipating in advance of those rate hikes and pushing rates higher. The reason we don't have interest rates on this gauge at a negative, like we do monetary policy, it's because while rates are quite a bit higher than they have been during the last 2 years, they're not a lot higher than they were 3 or 4 years prior. And I think most folks, especially the ones that can remember the high inflation and the high interest rate time periods of the 1980s, we really couldn't call today's interest rates high compared to history, just a lot higher than they were a year or two ago, but actually relatively similar to where they were in 2018 and 2019, as the Fed was, kind of, in their tightening mode after the subprime mortgage crisis recovery. So we're neutral on interest rates, neutral on valuations. We've seen a degradation in the economy growing and monetary policy, of course, and that investor sentiment negativity has led us to put that gauge at a very far forward.